September 15th, 2008. Lehman Brothers files for bankruptcy. 158 years of history. $639 billion in assets. Gone overnight. Just days earlier. Markets were calm. Banks were labeled well-capitalized. Risk was said to be contained. Then the machinery stalled. Credit stopped moving. Trust drained out of the system. The global economy froze mid-step. This wasn't unprecedented. In 2001, Enron collapsed with $63.4 billion in assets. In 1929, the Dow Jones lost more than half its value in a matter of months. Different times. Different markets. But the same outcomes, small risks ignored. Then everything breaking at once. To understand how collapses like this keep happening, you don't start on the day everything breaks. You start years earlier, when nothing seems wrong. After the Great Depression, financial markets were tightly regulated. Banks were boring by design. Risk was limited not because bankers were virtuous, but because the rules made recklessness expensive. Then, slowly, the rules changed. By the late 20th century, deregulation became the new religion. The idea was simple: fewer constraints would unleash innovation, efficiency, and growth. And for a while, it worked. Profits soared. Financial firms became smarter, faster, and far more creative. Too creative? Risk didn't disappear. It just learned how to dress better. Instead of sitting plainly on bank balance sheets, it was sliced, repackaged, and sold. Mortgages became securities. Securities became derivatives. And derivatives became something most people couldn't explain, but everyone trusted. Low interest rates added fuel to the fire. Borrowing was cheap. Housing prices climbed. Owning a home stopped being a milestone and started looking like a shortcut to wealth. Banks responded by lowering standards. This is where ninja loans enter the story. No income, no job, no assets. Loans issued to borrowers who, under normal circumstances, never should have qualified. Not because bankers thought these borrowers were safe, but because the loans wouldn't stay on their books. They would be sold, securitized, and passed along. The logic sounded airtight. If everyone shares the risk, no one really carries it. But systems don't work on slogans. They work on incentives. And the incentive was clear: make the loan. Collect the fee. Move on. At the surface, everything looked stable. Underneath, pressure was building. Once the machine was running, it started to feel unstoppable. Housing prices rose year after year. Stocks climbed. Credit was everywhere. And each small success reinforced the same belief: the system was working. Banks didn't see risk. They saw demand. Investors didn't see leverage. They saw yield. And regulators? They saw growth. This is how bubbles don't announce themselves. They blend in. At the height of the boom, owning a home stopped being about shelter. It became a strategy. Refinancing turned rising prices into instant cash. Equity felt like income. And debt felt harmless, because everyone believed prices could only go up. On Wall Street, complexity became a selling point. Financial products grew so layered that even their creators struggled to explain them clearly. But that didn't matter. What mattered was the label rated AAA, classified as investment grade, and treated as safe. If the rating said it was safe, the discussion ended there. Banks earned fees for originating loans. They earned more fees for packaging them, and even more for selling them. Risk wasn't removed, it was relocated. And because it no longer sat visibly on anyone's balance sheet, it felt lighter, like trash taken out of the house. The logic sounded reasonable. Spread the risk across millions of loans. Slice it into tranches. Sell it globally. No single failure could hurt the system. But systems don't break at their strongest points. They break at the assumptions everyone stops questioning. Meanwhile, ordinary people were being pulled into the same current. Mortgage approvals arrived faster than paychecks. Down payments shrank. Documentation disappeared. You didn't need proof. You needed confidence. The pitch was simple. Housing had never failed nationally. And if it had never failed before, why would it fail now? That sentence did more damage than any spreadsheet ever could. Because once belief replaces verification, the system stops measuring risk. It starts manufacturing it. By the time cracks began to show, the boom had already rewritten expectations. Falling prices weren't just unlikely. They were unthinkable. And that's when bubbles become dangerous, not when people are greedy. But when caution feels unnecessary, every collapse is preceded by warnings. The problem is never the absence of signals. It's how easy they are to ignore when the machine is still paying out. By the mid-2000s, the numbers began to whisper a different story. Mortgage defaults ticked upward. Adjustable rates reset higher. Borrowers who had never proven income started missing payments. Nothing dramatic. Nothing headline-worthy. On Wall Street, analysts noticed inconsistencies. Models still showed stability. But reality was getting noisier. Some desks quietly reduced exposure. Others doubled down, convinced the data would correct itself. Inside companies like Enron years earlier, similar moments had passed unnoticed. Internal memos raised concerns about accounting practices. Risks were flagged, then reframed as temporary. After all, the stock price was still rising. In markets, price has a way of silencing doubt. Accounting rules made the illusion stronger. Mark-to-market allowed firms to book profits today based on what they believed assets were worth tomorrow. As long as prices rose, balance sheets looked healthy. Losses didn't disappear, they were postponed. Meanwhile, complexity did its quiet work. Products had become so layered that tracing risk back to its source felt unnecessary. If something went wrong, it would surely be absorbed somewhere else. That belief turned caution into a nuisance. Regulators saw the same data and reached the same conclusion as everyone else. There was no single point of failure. The system looked diversified, spread out, safe enough. But systems don't fail because one number flashes red. They fail because many small warnings arrive without urgency. By the time prices stopped rising, the story everyone told themselves had already hardened. Housing couldn't fall nationally. Markets would stabilize. Liquidity would return. Those assumptions weren't reckless. They were familiar. And familiarity is how danger hides in plain sight. Collapses don't arrive politely. They arrive all at once when the assumptions finally stop holding. In 1929, it began with hesitation. Prices slipped. Investors waited for the bounce. Then came Black Monday. The Dow Jones fell nearly 13% in a single day. Black Tuesday followed, down almost 12%. Phones rang without answers. Orders piled up faster than they could be processed. Within months, more than half the market's value was gone. The problem wasn't panic. Panic was the result. Decades later, the pattern repeated with new instruments and faster wires. In 2001, Enron unraveled, not in theory, but in real time. Analysts downgraded the stock. Counterparties demanded collateral. Confidence vanished. On December 2nd, Enron filed for bankruptcy with $63.4 billion in assets. Employees walked out carrying cardboard boxes. Pensions locked inside accounts that no longer existed. Then came 2008. By September, trust between banks had thinned to almost nothing. Institutions stopped lending not because they lacked money, but because they didn't know who would still be standing tomorrow. Short-term funding markets seized up. Overnight loans stopped rolling. Lehman Brothers sat at the center of that freeze. On September 15th, the bank filed for bankruptcy with $639 billion in assets and $619 billion in debt. 26,000 employees lost their jobs. But the damage spread far beyond one firm. Money market funds once treated as cash broke the buck. Global trade stalled. Companies that had nothing to do with mortgages suddenly couldn't finance inventory or payroll. The system didn't slowly decline. It snapped without warning. What made this collapse different wasn't size alone. It was speed. Financial markets had become tightly coupled. When one part failed, others didn't have time to adjust. Liquidity vanished before anyone could react. This is the part most models miss. They assume time. They assume orderly exits. They assume tomorrow will arrive. But in a crisis, tomorrow is canceled. Every institution tried to protect itself at the same moment. Sell assets. Hoard cash. Reduce exposure. Individually rational decisions collided and became collectively destructive. What looked like stability for years turned out to be fragility in disguise. And when the dust settled, one thing was clear. The system had not been built to fail safely. When the system broke, the damage didn't stay on trading floors. It moved outward fast. Jobs disappeared first. Millions of them. Not just at banks, but across industries that depended on credit to function. Factories slowed. Construction stopped. Small businesses lost access to short-term loans they had relied on for years. For many households, the collapse arrived quietly. Retirement accounts shrank. Home values fell below mortgage balances. People who had never missed a payment found themselves underwater not because they had gambled, but because the system had. Governments stepped in, not out of generosity, but necessity. When markets freeze, politics follows. Trillions of dollars were mobilized to stabilize banks deemed too important to fail. And to the public, it felt contradictory. Losses were private until they weren't. Risk was rewarded on the way up, then socialized on the way down. Reforms followed, as they always do. After Enron, corporate reporting tightened. After 2008, capital requirements increased. Stress tests were introduced. The most extreme lending practices, like ninja loans, were pushed to the margins. On paper, the system became safer. But paper has a short memory. The deeper lesson wasn't about mortgages or accounting rules. It was about incentives. When profits are immediate and risks are delayed, behavior doesn't change, it adapts. New products appear. New justifications emerge. The same logic returns wearing a different name. This is why financial crises don't repeat exactly. They rhyme. Each time, the story sounds reasonable. Each time, the risks seem manageable. Each time, the confidence feels earned, until it isn't. The real cost of these collapses isn't measured only in dollars lost. It's measured in trust in markets, in institutions, and in the idea that stability is something we can assume rather than maintain. And once that trust breaks, it's far harder to rebuild than any balance sheet. Looking back, none of this feels mysterious. The warning signs were there. The incentives were clear. The assumptions were familiar. What failed wasn't math. It wasn't technology. And it wasn't a single bad actor. What failed was the belief that stability could be assumed instead of maintained. For years, the system rewarded speed over caution, complexity over clarity, and confidence over verification. Each cycle felt smarter than the last. Each new product promised to smooth the rough edges left by the previous crash. And each time, the story ended the same way, not with villains being punished, but with ordinary people absorbing the cost. Financial history doesn't move in straight lines. It moves in loops. The names change. The instruments evolve. The charts look different, but the underlying behavior remains stubbornly human. So the next time markets feel calm, ask what's being ignored. When returns look effortless, ask where the risk went. And when someone says, "This time is different," remember how often that sentence has been spoken right before everything wasn't dat. If you want to understand finance, don't just follow the gains. Follow the failures. Because the real lesson isn't that systems collapse. It's that they collapse quietly, long before anyone is willing to admit it.